Good evening, ladies and gentlemen. This is Barry Norman on behalf of CMS, and welcome to our class on Moving Average Convergence and Divergence, better known as MACD. Now, tonight's class is sponsored by CMS Trader, one of the world's leading platform providers for CFD and Forex trading. If you want, while we're in class tonight, you can go to www.cmstrader.com and open a demo account. No credit cards required, and start using their charts to follow along as we learn how to use MACD. Now, CMS Trader is a regulated provider, and therefore I'm required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, CMS Trader is one of the best and leading platform providers. And if you just go right now to www.cmstrader.com, if you can't access their site, it means that they're not regulated in your country or your region, wherever you're visiting us from, but you can still enjoy the webinar. But if you just go to their platform and click on the buy or the sell button, it's going to open up a little window that asks you to put in a email address and select a password, and you'll have a demo account open for you in seconds. And CMS Trader provides you lots of tools when you trade with them. There's no conflict of interest between broker and trader. There's no dealer intervention. And they offer a very broad range of education for novice traders all the way up to experienced and professional traders. They also offer multiple account types. They give you free daily signals. They give you free daily market updates and technical analysis. And they give you extremely fast trade execution. They offer a wide variety of instruments you can trade Forex or CFDs for stocks, commodities, or indices. And if you want, especially if you're a novice trader, you can use their watch, copy, and profit social trading, where you can watch and see how all the other traders on their platform are trading and decide if you want to copy one of their trades with one click and just duplicate their trades right on the spot. And that stops you from doing all that involved complicated decision making, and you can just follow along with their more experienced traders. Or you can learn to become an independent trader with CMS Trader, and they'll set you up on one-on-one sessions with financial experts. They'll provide you ebooks, video tutorials, everything you need that you can conquer the markets on your own. So let's talk about, or let's get ready and let's get started on understanding MACD. Now, MACD is one of the most well-known, most popular, best used technical indicators. It works well for stocks, commodities, Forex, or anything else, especially cryptocurrencies, that you're trading on an online platform. Now, MACD was developed by Gerald Arpel in the late 70s. And so that tells you right off the bat, it was developed for stock markets because in the late 70s, we didn't have Forex or CFD online trading, didn't even exist. But over time, it has been reconfigured by Mr. Arpel to fit all the modern online type trading. Now, MACD is used to spot changes in strength, direction, and momentum, and the duration of a trend. MACD is one of the most popular and broadly used indicators in Forex trading. The letters stand for Moving Average Convergence Divergence. It's a lot to say, but I actually like saying it. It's a pretty cool name. The MACD indicator, which requires moving averages as its input, falls into a group that's called lagging indicators. The basic function of the MACD Forex indicator is to discover new trends and to help identify the end of current trends. There are various ways to gauge signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now, I'm going to forewarn you, okay? We're going to go step by step so we understand each line and each calculation that's used in MACD, because you need to understand where the data is coming from so that when you're using MACD and something weird happens in the market, you can realize or notice it in the MACD indicator. And the MACD indicator is a derivative of a derivative of a derivative of a derivative. So it takes lots of words to explain all this. And we're going to go through it step by step so that you understand each line that is on that MACD indicator and where it comes from. Because when you understand all this, you can see very good patterns and signals in MACD. And you can also see when you're getting a false signal because you understand what is happening. Now, the MACD indicator is placed below your charts. So over here on the example on the right-hand side, you can see a price chart, and the MACD indicator is dropped below. Now, even though we're going to go over all of these lines, and you see all of these lines, there's 4 lines and what's called a histogram or a bar chart that make up the MACD. Now, once you understand these lines, you don't ever have to do any calculations because it is such a popular indicator that every charting service will just drop it onto your charts for you. But you need to understand what these lines are because we have a MACD line, we have a signal line, we have a MACD histogram, and they are all derived by 2 moving averages that are from the price action on the charts. So we're going to work through each one of these lines, and then we're going to go together and place these on a live chart. So the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26-day and 12-day exponential moving average. Now, an exponential moving average is basically just a variation of what's called a simple moving average. Now, what's a simple moving average? You would take a 12-day, or we should define it more as a 12 period, because if you're using a 15-minute chart, it's 12 15-minute bars. If you're using a 1-day chart, it's 12 days. But it would take the 12 days close, add them together, and divide it by 12, and that would give you the moving average for that 12-day period. But an exponential moving average gives a little bit more weight to the more current numbers. And so it's a little bit more complicated calculation, but it gives you a little bit more accurate. Now, here we're using 2 moving averages, a 26-day, okay, and a 12-day. The 26-day, and don't think that you can change these, but once you change them, they're no longer MACD because this is the way that Gerald Arpel developed it. And this is how it's tested and true. If you decide you want to use a 10 and a 20, then it just becomes Barry's technical indicator or Jones technical indicator. Now, if you can understand the basics of a moving average, the longer the period of the moving average, the slower that moving average reacts to changes in the most recent movement. Because when you're taking 26 periods, and even though you had a big movement in the last few days or the last few hours, okay, it's still factored back over 26 periods and divided by 26. Where the 12-period moving average is only divided the last 12 periods, so it is considered what we call a faster moving average. It reacts faster to changes in the current market situation. A 26-period moving average reacts a little bit slower. So we refer to these as the slower and the faster moving averages. That's it. Nothing very complicated here. So let's go over to a live chart and start putting this together on a chart manually. And then I'll show you just how easy it is after that it just gets put on a chart. So let me pop up some live charts on our screen here. Okay, so right now we're looking at the Euro US dollar on tradingview.com. And we're looking at it in a 1-hour chart, only just because this is my standard chart. No other reason. So we could be looking at a 15-minute chart, a 1-day chart, Okay, doesn't make a difference. Now, what we have to do here is we need to drop a moving average on our chart. So we'll go up here to indicators and we'll scroll down here to moving average. And we're going to put an exponential moving average on our chart. So I click that and it's dropped a moving average on our chart. It's this light blue line. We're going to darken it up so you can see it better. So we're going to change some settings here. And the first thing we want to do is we want to change our inputs, because what do we need to be using? We need to be using a 12 and a 26. So first we're going to start with a 12 period moving average. And just for class tonight, we're going to change this to a red, and we're going to make it a lot thicker. So we know the red line is our 12 period moving average, okay, which means it's our faster moving average. We also need to drop on here a second moving average line. So we're going to go up to technical indicators again. We're going to scroll down here to another moving average. Again, exponential. And we have the blue line here, and we're going to change this one. We'll leave this one blue. We're going to make it broader, and we need to change this to a 26. So we have our blue line here, which is our 26 period moving average. And what does this say it is? That means it's the slower moving average. So now we've started the first part of MACD. Okay? This is not the MACD indicator. This is the first derivative that we've got to come up with to start calculating or start putting together our MACD. So let's go back to my PowerPoint and figure out what the next step is that we need to do. So now we have the 12 and the 26. So in their calculation of their values, both moving averages use the closing price of whatever period is measured. On the MACD chart, a 9-day EMA of the MACD itself is plotted, as well as it acts as a trigger to buy and sell decisions. The MACD generates a bullish signal when it crosses over above its own 9-day EMA and sends a signal, a sell signal, when it crosses below its 9-day EMA. Now, what is this 9-day EMA we're talking about? So we got to figure that out now. So what we have to do is we have to now figure what's called the signal line. And the signal line is the first line that is put on the technical indicator below the chart. And this line is a calculation of the difference between the 26-day and the 12-day moving average. It's simply subtracting one from the other and then plotting it on a chart below. So our MACD indicator below uses a zero line, which we just draw across here and name it 0. And then we would subtract the difference between the 12-day, the 12-day and the 26-day moving average. And then we would plot the difference down below, I'm sorry, on the MACD line, the blue MACD line. It's called the MACD line. And we simply subtract them from each other and plot them on this blue line below. Now we get a little bit more complicated. We have to come up with what's called the signal line. The signal line is a 9-period moving average of the MACD line itself. See, like I said, it's a derivative of a derivative of a derivative. So we started out with a 26 and a 12-day moving average. We plotted the difference of those and formed the MACD line below. Okay, so we subtract one from the other and plot it below here on our MACD line. We draw a line anywhere we want on the charts below and call it the zero line. And when we subtract this number from that number, if it's -1, -2, -47, we plot it here. If it's a plus number, we plot it above the zero line at whatever that number will be. We then take that number for each one of those periods that we subtracted from one another. We take 9 of them and put them together and divide it by 9, and that gives us what's called the signal line. So what we have is a derivative of a derivative of a derivative of a derivative. And this gives us our MACD line and our signal line. When the MACD line crosses over or below the MACD line, so when the two cross, they give you buy signals and sell signals. Okay. Not the moving averages up above, because if you notice on our chart up here, there's actually no moving average on the actual chart itself, because we don't use the moving averages on the price chart except in the very beginning to start our calculations. But when you put the indicator on the chart, that does not remain. Now, MACD is all about visual, or seeing a visual representation of price. So, like I said, it's complicated. So when we look at this little graph here, we can see, okay, we have the 9-day and the 12-day. We then have calculated that into the MACD line and the MACD signal line. Now, why do we no longer need these? Well, when the 26 period and the 12 period cross over, what would the difference of those be? They would always be zero. Because when they're exactly the same, they have to, in order to cross over, they have to be exactly the same. So when they move over, below, or above each other, they would always cross the zero line below. So this makes it easy. So when the 12-period moving average crosses above the 26-period moving average, or the MACD line crosses below the zero line below. So when we see this line, the MACD line, cross above or below the zero line, we know exactly what happened on these two lines. They crossed over. So we no longer need this moving average on the chart. So now we form the MACD line, the MACD signal line, which is simply a 9-period moving average, which just reinforces the value of this signal. So when the blue line crosses above and below, or whatever color line, see, when you do your charts, you can decide whatever color lines you want. But you need to know which one is the signal line and which one is the MACD line. So let's go back to the charts where we started plotting this in real life. So what we have right now are our blue line and our red line, our 26 period and our 9-period moving average. Now I'm going to get rid of these because we're going to add the MACD indicator onto the bottom of the chart. So to save you all of those calculations, you simply go up to your indicator, scroll down to where it says MACD, or Moving Average Convergence and Divergence, click on it, and it's already done it all for you. So what do we have? We have our fast moving average and our slow moving average, which are at 12 and 26. And we have our smoothing signal at 9. So let's take the MACD line, and we're going to keep that in blue, and we're going to make it dark blue just so you can see it very, very well. And I'm going to make it broader. And then we're going to make the signal line in red so it matches the charts that we had over here. And then we're going to take our histogram, because we haven't even gotten to talk about the histogram, and we're going to make that gold. Make that a little bit. And I'm just doing this so you can see it better. But you need to know always which one is your signal line and which one is your MACD line. So in this case, we made the blue the MACD line and the red the signal line. So the MACD line is simply a subtraction of what the moving averages would have been on this chart, the 12 and the 26. And the red line is simply a 9-period moving average of the blue line. And this is the MACD moving average convergence indicator. Now we go one more step. Okay, and this one more step isn't really a change in mathematical calculations, but it's done to give you a visual representation of what all of this is doing. And this is the gold histogram we have at the bottom. A histogram is just a little bar chart. Now all of these are drawn on the 0 line. Let me just put a marker on here for you. So you can see every time it's always, doesn't matter where you have the 0 line, but it's all done above and below 0. So this line here where everything is revolving around is 0. Now, when we take the difference between the MACD line and the MACD signal line, the red and the blue line, and subtract them, we can then plot them on the histogram. So what the histogram does, it gives us a final visualization of all of the derivatives we're looking at, because the MACD line generates signals in 3 different fashions. The first and the most well-known is when the red line or the signal line crosses the blue line. Now, when it crosses this blue line, what is the difference? It is 0 again. So we can see this on the histogram, that each time these lines cross, the histogram is at 0. If the blue line, the MACD line, is larger than the signal line, guess what we have? We have the histogram moving up. If the signal line had crossed over the blue line and the MACD line was falling lower, it would be a negative number or below the 0. So what we've done is we've crunched all of these different derivatives into one visual effect. Now, if you get used to looking at the histogram and trading from it, you can see everything in all 4 of these lines directly in this histogram. And it gives you this nice little smoothed out visual effect of the MACD. But most people use the signal line and the MACD as well as the histogram. They don't use the moving averages on the chart because we have no need for those moving averages. And we don't want to deal with the crossovers from those moving averages. We're more concerned with the crossovers of the MACD and the signal line below, because they've been derived from the price action up above and those two to give us more information. So let's go back to my PowerPoint. And I know this was all very wordy and lots of words and text to simply then end up dropping it on the chart. But you have to understand where these lines come from. And if you understand why one is crossing over and how it becomes 0 and how the histogram represents all of these numbers, you better understand the indicator and what it's trying to tell you. So basically, in downtrending markets, the fast moving average will move down faster than the slowing moving average. As the fast moving average diverges from the slow moving average, the MACD will illustrate that relationship. And in uptrending markets, the 12-period EMA should move faster than the 26 EMA. As such, the MACD will move higher to express that growing difference. So our MACD line, which is the line we put on our chart in blue, okay, tells us the strength of the trend and how it is reacting to the 26 and the 12-day moving average. Okay. If this blue line is moving up towards the more positive side, and the more steeper it's moving, the more hard that current trend is in price, and also the bigger jump you've had in the most recent prices, because it's telling you that the 12-period moving average is moving much faster than the 26 period. If you see the reverse, then it's telling you the exact opposite. And all that can be found in this MACD line, the blue line. Uh-oh. Hold on, I lost my mouse here. Okay. Now, there's lots of ways to start interpreting this, okay, because we have crossovers, we have divergences, and we have convergences. And many people mix these terms up. So it's very, very important that we understand the three different stories that we get out of the MACD signal, because the MACD proves most effective in wide swinging trading markets. There are three popular ways to use the moving average convergence divergence. One is crossovers. So we would be looking at and trading the crossovers between the signal line and the MACD line. Or every time the histogram touches zero. These would be crossovers. It will also tell us overbought and oversold conditions in the market, and it will show us divergence. These are three separate ways, or three separate patterns, or three separate pieces of the MACD that we can use in three different determinations of the marketplace. So the first thing we're looking at is crossovers. So the basic MACD trading rule is to sell when the MACD falls below its signal line, similarly to buy when the MACD falls above its signal line. Now, we don't use the 12 and the 26 crossovers, because then you're simply using a basic moving average crossover on your charts. And this is one of the reasons we don't chart it, put it on our charts after we've got the MACD. We're concerned with the crossovers between the MACD line below and the signal line. So remember, as I explained to you, when they cross over, they're always at zero. But the basic MACD trading rule is to sell when the MACD line, okay, in this case it's the black line, in our case it was the blue line, crosses the red signal line. If it crosses above, okay, or crosses below. So when the MACD line moves down, falls down below the signal line, okay, that means the MACD line is falling below the signal line. It's a sell signal. When it crosses above the signal line, it is a buy signal. And MACD generates a lot of these. And one of the reasons you will not use a MACD indicator as your only determination is it generates many signals. They're not necessarily what we would call false signals. They're not giving you misinformation. The MACD signal, crossover signals, tells you that the asset is going up or down. But the thing is, it doesn't tell you how far it's going to go up or down. So you need to use other determinations, because it could be completely correct and tell you the asset's going to move up, but it might not move up enough to cover your spread. It might not move enough up for when you end, by the time you get around to making your buy, that it's going to not fall right back down. So it's giving you alerts. It's saying, okay, we have a buy trend. But you need to combine it with other indicators to verify the strength of the signal and whether you should actually be making the trade. So think of it as an alert. It's saying, hey, look at me, here's an opportunity, but check this opportunity. So this is the crossovers. So this makes what part of the MACD, Moving Average Divergence and Convergence. So the first part is when the moving averages cross over each other. Now, you see them occur a lot. And if you notice on my sample chart here, they're very accurate. But again, how far that trend will move in that direction, we're not sure about. Now, the next way that MACD helps you is it gives us what's called overbought and oversold signals. Overbought and oversold signals alert you to possible changes in the trend. But remember, the term overbought and oversold doesn't mean that that trend is going to change immediately, because an overbought market can remain overbought. An oversold market can remain oversold, but it's telling you to prepare for a change in the trend. Or if you're in that market, it might be telling you it's time to sell out of that market. So when the shorter moving average pulls away dramatically from the longer moving average, the MACD rises, it is likely that the symbol is overextending and will soon return to more realistic levels. So in other words, when we can draw a trend line or a line over top of the MACD line, and we're showing the MACD line is either risen significantly or fallen significantly, it's telling us that that indicate that asset might be overbought or oversold. And then lastly, we have divergence. Divergence is one of the best parts, or one of the best or strongest indicating parts of the MACD. When we get divergence, it's an indication that the end of the current trend may be near, and it occurs when the MACD diverges from the symbol. In other words, when we look at the MACD line on the chart, okay, and the MACD line is moving upward while the price movement is moving downward, we're having a divergence. So what we see here is the MACD line is making higher lows while the price is making lower lows. So we see price moving in this direction, but we see the MACD line moving in the opposite direction, means that the symbol movement and the indicator are diverging. And this is telling you that the end of that trend is occurring. Now, a bearish divergence occurs when the MACD is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold levels. So when we combine that with the overbought and oversold, like we have in the prior story of this, hold on a second, let's go back to the chart. So as you can see over here on this little chart, and I'm sorry I can't make it much bigger, we see two different stories displaying. We see the chart, the price chart, moving in higher highs, but we see two things here. We have an overbought, we have a drastic movement in the MACD line, plus we have a divergence of the MACD line. So we see the blue line, okay, showing a divergence, because the blue line is moving down on the indicator, and the price line is moving up. We also have this very, very large movement or the big fall in the MACD while price is rising. So we're seeing a drop in MACD while price is rising. So it gives us a combination of two different parts of this indicator. So a bearish divergence forms when a security records higher highs and the MACD line forms lower highs. So you can see it drawn right here on my example chart. Very easy to see. We can combine that with one more thing by putting our support and resistance on the chart, and we might see a point where the price breaks the support or resistance level, securing us another way to see the movement, okay, or to verify this movement. Waning upward momentum can sometimes foreshadow a trend reversal or a sizable decline. Now, the final part of this comes in the histogram, because all of this can be contained in the histogram. The histogram is that little bar chart that we did in gold on our trading chart. The MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. That means that the MACD histogram is 4 steps removed from the underlying security. It is a 4th derivative of price. So the first derivative is the 12-period moving average minus the 26-period moving average. Or it's the 12 and the 26. The second derivative is the MACD line, which is a 12-day EMA less the 26 DMA. That's your MACD line on your chart below, the blue line that we put. Then we go to our third derivative, which is the MACD signal line, which is a 9-period moving average of the MACD line itself. And then the fourth derivative is the MACD histogram, which is the MACD less the signal line. See, I told you, it was a lot of words. The base for this indicator is always the security's price. It takes 4 steps to get to the actual price on the histogram. It is an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. So as with the MACD histogram is also designed to identify convergence, divergence, and crossovers. And this is what I was saying to you earlier. If you can get past looking at all of these lines and see all of this in the histogram, okay, you can then get away from all this and see this in a very easy visual representation of the MACD histogram. Because if you get to the point where you can see when the signal line and the MACD line cross each other, it's always at 0. If the signal line is lower than the MACD line, you're going to have negative numbers, so it's going to come downward on the histogram. If it's moving in the opposite direction, it's going to come upward. And then you can start seeing the strength of the movement by the height of the histogram and how dramatic that histogram is changing. And if we take that histogram and then drop volume underneath of it and put support and resistance on our charts, we could have the basics of really a whole trading system. So the MACD histogram crosses the 0 line as MACD crosses below its signal line. The indicator is negative when MACD is below its signal line. Negative values increase as MACD diverges further from its signal line. So this is one of the key parts of MACD, and it's transaction signals, trading signals, telling you to do something. It has become standard to plot a separate moving average alongside the MACD, which is used to create a clear signal line. That is our signal line. Okay. And when it crosses over, it generates what's called transaction signals or buy signals. Or whenever the MACD histogram forms a 0, it's telling you it's a buy or a sell signal. If it falls below, it's telling you to buy. If it goes above in the MACD histogram, it's telling you to sell. So the basic bullish signal, buy signal, occurs when the MACD line crosses above the signal line. And the basic bearish signal is generated when the MACD line crosses below. Traders who attempt to profit from bullish MACD crosses that occur when the indicator is below zero should be aware that they may be attempting to profit from a change in momentum direction. While the moving averages are still suggesting the security could experience a short-term sell-off. This bullish crossover can often correctly predict the reversal in the trend. Now, as mentioned earlier, the MACD indicator is calculated by taking the difference of the short-term moving average and the long-term moving average, and we keep talking about this. Given this construction, the value of the MACD indicator must equal to zero each time the two moving averages cross. So you can notice how the crossover below the zero line can be used to predict the start of an uptrend, and the cross below the start of a downtrend. So in previous examples, the various signals generated by this indicator are easily interpreted and can be quickly incorporated to any short-term trading strategy. At the most basic level, the MACD indicator is a very useful tool that can help traders ensure that short-term direction is working in their favor. So, and as I mentioned earlier, the biggest disadvantage of using the indicator to generate transactions is that the trader can be whipsawed in and out of positions several times before they're being able to capture a strong change in momentum. As you see in this chart, the lagging aspect of this indicator can generate several transaction signals during a prolonged move, and this can cause a trader to realize several unimpressive gains or even small losses during a rally. And this is why you should be using at least volume and support and resistance levels to confirm the signal and whether you can actually trade it. So be aware, another MACD indicator is its inability to make comparisons between securities. Because the MACD is a dollar value between two moving averages, the reading of differently priced stocks or assets provides little insight when trying to compare a number of assets to each other. So in other words, if you're using RSI and they have a rule, RSI at 73 and higher is a sell or a buy signal, overbought and oversold, and below 30, it's easy to do that from asset to asset. Here you have to look, because it's using the dollar difference or subtracting the value from one to the next. You need to look at it, especially in different markets, slightly differently. The MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers, the signal line, make it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than MACD. It's been around for 40 years, and this relatively simple indicator can quickly be incorporated into any trading signal. So if there were ever a quest in the world of investing on par with the search for the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success. But the most common tracking tool is the two-line moving average convergence and divergence. This tool measures an asset's momentum and can aid investors in spotting trend changes. So remember, just like physics, momentum changes occur before the price of an asset changes. And there are many other ways that you can apply MACD. And there's all types of things available in the marketplace. All kinds of weird things. There's channeling. Lots of things that I don't use and I'm not even familiar with, because there's some guru who came up with different ways to use these. But the bottom line, the strength of the current trend can be measured by channeling the MACD. Spot trend reversals by looking for divergence in momentum as measured by the MACD channel. Okay, and that's simply putting an uptrend and a downtrend line above how, on the lines on the MACD chart. Determine buy and sell signals using the MACD crossovers and bounces off the channel line. Learning to implement and recognize These different signals help investors increase their profits when trading short and intermediate term trends. And again, I use the histogram. I just want to see it in a nice visual manner and see the price moving above and below my zero line, and I can see how strong that momentum is by the shape and the size of the histogram. So remember, life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. However, a logical methodological approach for violating these important money management rules needs to be established before attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea, divergence. Applying this method to the Forex market, which allows effortless scaling up and down of positions, makes this idea even more intriguing to day traders and position traders alike. Now, you're saying, how can I master all this? Well, let's go back to the charts real quickly. And we're going to wrap this up. Okay. Now we have our MACD on our charts. Okay. We did this all ourselves step by step. So you know what every one of these rules are and what every one of these lines mean. But now many charting services offer MACD strategy, which is the standard Gerald Arpels strategy. And we can scroll down here on TradingView and locate the MACD strategy. Just click on it. Okay, why isn't, there we go. It just takes a second. And what it's doing is simply dropping our crossovers onto our actual charts. So we can combine it. Now we can set this any which way we want. We can design it and customize it, but we can trade on the charts. We can put our signals, so we can put our inputs on here. So we're always staying at a 9, 12, and 26. We can put our properties on here, our style, okay, and all of that. We can color code it, make it fit whatever we want. And now we're getting these signals drop right on our charts, right at the price. So if you're using this with Japanese candlesticks, you have it right there. Okay, somebody just asked me a question that I've answered 5 times tonight, and I'll answer it one more time. Can we use 12 and 6-day averages? What would be the difference? As I said, Gerald Arpels developed this with a 12 and a 26 moving average. It's been tested for 40 years using this. If you want to make it 12 and 6, then the rules no longer apply. The strategies no longer apply, because that becomes your own indicator. And you'd have to back test it. You'd have to market test it. You'd have to do all the research to see how it would change the way the indicators work. Gerald Arpels didn't wake up one morning and say, I'm going to do this with a 12 and a 26 and a 9. These were tested and tested and back tested and tested forward, and have years of testing, and the strategies are all based on that. Any indicator can be modified to your own use, but then it becomes your own indicator. And that's what you'll have. You'll have lots of gurus out there pushing their own adaptation. So somebody might say, change this to 14 and 9. And here's my rules of trading to 14 and 9. But if you change any of these, it's no longer fits this indicator. It no longer fits what you're going to read on the internet. It's no longer going to fit the strategies it's going to be yours, and you have to test it. And you might test it for 100 days and it might work beautifully, but because you haven't tested it in all different markets, when the market changes, it may work terribly. So you can customize it all to your own, but then it's your own indicator. It's no longer MACD. It's your simple moving average trading scenario. No, I said I would take the MACD and combine that with other things to start building a strategy. I don't recommend any strategy, but if you want to know whether those signals it's generating are valid, you could use that with volume. You can use anything to make your own strategy. Okay, I'm not giving you a strategy because I trade for my own. Okay, so on that note, thank you very much for joining us tonight. But remember, you can use simple things, like I said, like MACD, volume, and support and resistance line. Because if you want to know if that signal's good, well, how did it react to that support and resistance? Did it just break above? Or did it bounce off of a resistance and support level? And is volume supporting that move also? So very good. Have a very good night. Okay. And again, I'll re-answer the same question I just got answered. How can you see a copy of this recorded version? I told you earlier, you just go to investing.com. In about 24 hours, look under education and then click under webinars on demand. So thank you very much. No, you can't get a recorded version. You can watch a recorded version. Okay. So thank you very much. Have a great night and all the best in this new year. And good luck in your trading out there. And remember, give CMS Trader a try. You'll see all of this right on their charts, and they'll have all types of education material to help you understand how to use this great indicator. Bye now, and have a great week.